Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. What is this SALT? Changes to law. What's going on? Who knows the answers to this? $10,000 deduction. I don't know this, and new rules. What's really taking place? So today I've assembled from California and from Philadelphia two leading tax professionals to provide their insight on the adoption of the SALT cap workaround and new and valuable tax breaks for residents and owners of business and operations in New York and other states. My guests from Southern California, we have bright-eyed and bushy-tailed Christian Burgess, who is the managing principal co-leader for the state and local tax of Friedman LLP. And from the city of brotherly love, we have Jay Brower, who is the partner and the state and local tax leader at Marks Paneth LLP. So we got you up early, Christian, this morning. Why don't you explain to my audience what was the SALT in 2017, which everybody's pissed off, especially if you're from New York or from California, because it limited to $10,000. Explain the SALT.
Absolutely. So prior to the tax reform, individual taxpayers were allowed to take a deduction for any state and local taxes paid, which included any state income taxes, property taxes, and even to a certain extent, sales taxes. And with the passage of the Tax Reform Act, the state and local tax deduction was actually capped to $10,000. Now, that impacted a lot of the states like California, New York, and other high income tax states where we are overly taxed. I mean, from an income tax perspective, we pay a significant amount in property taxes as well. And for a lot of high income taxpayers, that actually created an instance where we now saw an increase in our individual tax bills for federal purposes.
Jay, so what happened over the last couple of years? There's been legislation in different states. The IRS has made some legislation in the different states. Talk to me about the new legislation and this workaround. What do we mean by workaround?
Sure, Michael. So what happened was in 2018, the state of Connecticut, which like New York is a higher tax state up here in the Northeast United States, they came up with what we call a SALT workaround or a SALT limitation workaround for what are called pass-through businesses. This is partnerships and S corporations. And in the state of Connecticut, they passed this law that said if you are a pass-through business entity, you now have to pay an entity level income tax, whereas prior to 2018, generally, pass-through entities didn't pay state income taxes in the state of Connecticut. Some states do tax them, but Connecticut did not. So what Connecticut is doing is they're now imposing a tax liability at the business level, not the individual level. And therefore, because the tax is paid by the business itself, it is deductible, what we call above the line on your federal tax return. It's not an itemized deduction, nor is it subject to that $10,000 limitation that individuals have to limit their state local income and property tax deductions to. So you're sort of unfreeing the deduction now from the federal tax limitation. So Connecticut passed this tax in 2018. And just last year, the IRS came out with a notice which essentially looked at Connecticut's workaround and they blessed it. They said, yeah, this is not something that we think is abusive. And this is not something that when you get to the individual investor level, that they would have to add that tax back to their federal taxable income and then limit it to the $10,000 limitation. So once the IRS put that notice out, several other states started to look at what Connecticut did and said, oh, that looks good for us too. So we saw New Jersey do it. Theirs went into effect in 2019. I'm sorry, in 2020. Rhode Island. There's several other states have now come up with these SALT workarounds. Now, unlike Connecticut's, over in New Jersey, it's elective, so the business doesn't have to subject itself to the tax unless it wants to. And the IRS even blessed those situations too, where it's now even more obvious that this is a workaround the federal limitation. IRS says that's okay. It's still a business deduction because it's being paid by the business entity itself, not the individual, and therefore there is no limit at the federal level.
I think what I really need both of you to do is to explain on an individual basis. Let's take an example of an individual who may be operating as an LLP, because it says it's partnership, correct? So it has to be a partnership?
Or an S
Yes.
corporation. And it generally pass-through entity in general. So it could be a partnership, an LP, LLP, an LLC treated as a partnership, or an S corporation, where you have that flow through of the income.
So why don't we try to take this as an independent contractor so I can explain this to the lay people, including yours truly, okay, of what the item is. Okay, let's take a physician who's working in a practice, who's working in it may be a LLC or a subchapter S. Explain to me what this means, okay? The business had $250,000 of business, okay? The tax, what is the tax rate and how do they deduct it?
Okay, so for the New York tax, this physician would usually have to be practicing inside of New York State. He would be a New York State resident, presumably, as well. So his S corporation, if it elects into the tax, will pay an income tax to the state of New York now, whereas in the past, it would just pay what we call minimum tax just based on its gross revenue, usually a pretty small amount, a few $100.
This is an additional tax, is what you're saying?
This is an additional tax to the minimum tax or the gross receipts tax imposed on S corporations in New York. So the tax rate on the first, I believe, $2 million of income is 6.85%. So if his business, earned, say, $100,000 net,
Right.
It'll pay a tax of $2,650. That tax becomes a deduction on the company's federal tax return, and it passes through to him, the individual shareholder, as an ordinary deduction. So he will only pay federal income tax on the net difference, roughly $97,000 around there. That entity level tax of $2,650 is not subject to the $10,000 SALT limitation. So he gets that, that there's a full deduction for that tax. So that's where the advantage comes to him. Otherwise, without that entity paying the tax, he would be paying the tax to New York personally, where it would be subject to that $10,000 cap. And presumably, if the physician's paying a lot more than $10,000 in other state income taxes and property taxes in the state.
Now, how do they learn about this workaround? Okay, the standard subject is everybody's upset about SALT. Okay, that's a standard situation. from what I hear, it sounds like this is an additional tax that the person is paying. And even though it's deductible, it's still an additional tax.
It's an additional tax at the entity level, but it's really an alternative tax that you're getting the benefit of the deduction at the actual business level where the SALT limitation does not apply. As an owner of the pass-through entity, say in a partnership, if I owned 50% of a partnership, my half of that business's income will already come to me net of that state and local tax deduction. And when I file my personal income tax returns to the state of New York, for example, having made that election, I will be entitled to a dollar for dollar credit for all of the taxes that were paid on that distributive share of that income that I'm now reporting on my personal income taxes. And I mean, since these rules are relatively new, I mean, it's really incumbent on all individual taxpayers to reach out to their CPAs or whoever's going to be their advisors, their tax attorneys, to find out about these different programs, because the rules in New York are relatively new. Similarly with New Jersey, last year when the bait tax was recently was enacted, I mean, there's still a lot of issues and that we're working through in this compliance year, where the states came up with this grandiose plan to work around that state and local tax limitation. But I mean, we're still working out those kinks and making sure that how we calculate the income at the entity level is going to correspond with how we're going to report that income individually, and making sure that we're equalizing the amount of tax that we're paying both at the entity level as well as at the individual owner level, so that way that when we get that credit, it's going to offset completely the income that we receive from that business interest.
What if they don't want to take advantage of this program? Are they required? Jay?
You're not required to, under the laws in New York and New Jersey and most other states that have enacted these pass-through taxes. The only one off the top of my head where you have to do it is Connecticut. But again, most businesses, if it's a profitable enterprise, it's generally probably going to be worthwhile to at least consider doing it. There may be situations where it may not be such a good deal, depending on your investors. If they are residents of a state that maybe won't give a credit against its tax for the tax paid to New York or New Jersey. Like I'm here in Pennsylvania. Pennsylvania is saying we're not giving any credits for taxes paid by entities where the resident individual, such as myself, is a Pennsylvania resident. So I would lose. Really should be a profitable business. It makes no sense to elect it if it's a business showing losses. Also, if the business is a pass-through entity which doesn't have any individual owners, it may not make sense, especially if it's all corporate owners. And it's, there is no SALT limitation at the corporate level, so there probably doesn't get you anything by doing it. But again, if it's a profitable business with most of its residents or most of its owners living in New York, New Jersey, Connecticut, I think for those businesses, this may be a real home run for them, for the owners here.
I mean, when you say there's a real home run, I really want to try to identify an example. I mean, we utilized the physician before, okay? Mm-hmm. Let's take a sole proprietor who's doing some type of business, okay? And right now, they've been operating as a limited liability corporation or an LLP, okay? What should they do? What should their advisor, okay? This is not easy to understand in an initial approach. How do you educate the consumer that this is a program over there? Because what they hear about SALT is there's a possibility that it might be repealed. So let's try to figure those points out.
So Michael, you mentioned a sole proprietor. Let's first stop right there. Sole proprietors can't elect into this tax in New York and New Jersey and Connecticut. So you need to perhaps revise the way that your entity is structured. You could still be an LLC, but maybe you have a 1% owner, maybe it's your spouse. Maybe you form a corporation just as a special purpose entity to get your company, your LLC, into the realm of partnership taxation. So once you're a partnership, then you can elect into the tax and pay it. And now the partnership, which used to be your proprietorship, will be subject to the tax. It will pay the tax. It will get deductions for it. Those deductions will reduce your federal taxable income. It will also reduce your federal self-employment tax income. So you're getting the benefit twice there. You're reducing both ordinary federal taxable income and self-employment taxable income. So you get a little bit more bang for your buck there if you're operating now as a sole proprietorship and you convert that to a partnership. You can also convert it to an S corporation and do it there as well, especially if all your business is inside of New York State. That may also make sense. So that way you don't have to bring on a second partner or second owner. You can just elect, your LLC can make an election to be taxed as an S corporation.
Are there specific states, Christian, that it's better to do this with? Okay, is it California? I hear Connecticut, I hear New Jersey, I hear New York. Okay,
Yeah, there are a lot of states that are actually jumping on that bandwagon to enact legislation to establish these pass-through entity tax regimes as a workaround for the state and local tax limitation. California's legislation is still pending. The states that we are currently focusing on are New York, New Jersey, Connecticut, Rhode Island. These are states that have already enacted over the last couple of years these new tax schemes to circumvent that tax cap on the state and local tax deduction. If we look at it in the context of an example, as you were mentioning, let's assume that you have Michael and Jay LLP. You have Michael and Jay that are equal partners in this limited partnership, and the limited partnership generates, say, 2 million of ordinary business income. Now, typically, you would, as partners, you would get that income as a K-1. Each of you would report $1 million in ordinary business income from your interest in that partnership on your 1040. Well, let's just assume that your tax rate at $1 million is the 30%. So just assume that for state purposes, you're paying tax at 10%. So your state tax expense on that $1 million of your ordinary business income from your partnership interest is $100,000. Obviously, under the new federal rules, that $100,000 is capped at $10,000. So you're not getting the benefit for federal purposes of a $90,000 deduction that would have existed pre-tax reform. Now with the new pass-through entity taxes in New York and New Jersey and some of the other states, if you make the election at the entity level, your limited partnership can now pay the taxes on the $2 million. And let's say the same tax rate applies at the 10%. So the entity is going to be paying $200,000 to, say, the state of New York on the $2 million of ordinary business income. When it comes time to distribute that income or to treat that income for you individually, when you receive your K-1, you're now getting, instead of the $1 million, let's say your distributed share again is the 50%, you're getting a K-1 for $900,000, which is net of that state tax deduction because it's already baked into the ordinary business income. So your K-1 already has that tax deduction already taken into consideration. So when you report your your income, say to the state of New York, you're not reporting $1 million, you're reporting $900,000. And to the extent that you're paying taxes on that income, you're now getting a dollar for dollar credit, theoretically, on the taxes that were already paid under that pass-through entity tax regime.
many people that we know get involved with real estate partnerships. They want to buy an asset. They're interested in buying an investment right now. How would you recommend they set it up? Okay, because what you're talking about in the past is existing businesses. I'm talking about future businesses. What's the best way to set up a new business if you're in New York, New Jersey, or Connecticut, or Pennsylvania? Okay.
Well, typically, generally, you don't want to use a corporation, whether a C corp or an S corporation to own real estate. There used to have there used to be the 11th commandment: "Thou shalt not put real estate in a corporation." So usually, you want to purchase it and hold it in a limited partnership or an LLC, something that's taxed as a partnership entity, because it's easier to transfer interest back and forth and take property out, put property in without incurring a tax liability. Just partnerships are usually the better vehicle for holding real estate. And then maybe you purchase some real estate in New York City or in New York or in New Jersey. If it's going to be, throwing off taxable profits, and that's an important distinction to make, because you get depreciation and all this other good stuff, that real estate throws off, where maybe it's cash flow positive, but on the tax return it's showing a loss. If it's going to be throwing off taxable profits, at that point you definitely want to consider electing into a state entity level or PTE tax to get that tax deduction now paid by the entity itself. That tax paid at the entity essentially flows through down to the individual investors, where they can use it as a credit against their New York State or New Jersey income tax. So that's, in my mind, I think, just to answer your question, I think a partnership entity is usually the best way to go with acquiring real estate.
What about an estate? A trust or an estate being a partnership, being a partner in a transaction.
Yes, certainly. Estates and trusts can be partners in partnerships. It can be a little more difficult to make them owners of S corporations, but it can be done. But in most states, they tax estates and trusts for income tax purposes as if they are individuals. There's really no distinction between the two. Same at the federal tax level. So in New York, if you have a New York trust, it could be a partner in a partnership doing business in New York, and that same pass-through entity level tax and the resulting credit will flow down into that New York State resident trust and be used as a credit against its New York State income tax.
So here's a question. Can I amend my tax return from prior years?
No, unfortunately not. Once you have a certain time frame to make the elections. In New York, once you make the election, it's irrevocable. For the 2021 tax year, we have until October 15th of this year to actually make that election. In other states, like New Jersey, for example, the election may be revocable up until the actual due date of the return. So the rules will vary by state. As was mentioned earlier, you have other states like Connecticut, which are mandatory, so you don't have a choice. But keep in mind that once you make the election and you file your return, you're stuck whether you made it or not.
Quick question, and getting slightly off the topic. What happens if they appeal the 1031 rule for exchanges?
If that gets repealed?
Yes.
Well, that will certainly upset a lot of people that engage in real estate transactions all the time. So here we're talking about a federal policy which has been on the books for
Close to 100 years.
I'm guessing since the 50s at least.
Right.
Go back to the Starker case, and you're going back to ways where 1031 exchange has been around for a long time. I know that they have the gumption to get rid of that yet, but perhaps they do. They already did it with anything other than real estate a couple years ago. So maybe, yeah, that could be problematic for a lot of people that are sitting on real estate with substantial gains built into those properties.
Repercussions from a state tax perspective are going to be disastrous, depending on how the states treat that. Any changes to the federal laws will depend on how the state will either conform or continue to follow the old rules. And most states, given that this is going to be more of a revenue generating provision, I would suspect that most states would actually conform to any repeal at the federal level.
Yeah, and if they did, that would be perhaps a reason to elect into this tax. If you're going to be selling that, now you have to sell the property and recognize the gain, whether you flip it or exchange it for another or not. So if you're going to be forced into that thorn bush, well, you might as well just make the PTE tax election and get some state.
So here's the last question, which is, relating to both of you as professionals. How does the consumer or the individual learn about this workaround? I mean, I've done research and I've gone on the web and all the other information. How are you educating your customers and people out in the general public about the product? That what they should be doing.
Personally, my firm has put the information out on this. You go to our website, you can read all about it. I spent a couple of days last week putting together a list of frequently asked questions. I think I'm up to 30 or 40 questions in there that we anticipated people would be having. So you can go look at that. I'm sure, Christian, your firm has
Right.
other information on your website as well.
Yeah, we've issued a lot of tax alerts and other thought leadership pieces to inform our clients and the general public. We actively reach out to our clients that we identify that are going to benefit from these tax elections as they arise. Most of our clients and most businesses nowadays operate in a multi-state environment. So as more states start adopting these new pass-through entity workarounds, we're informing everybody to identify those opportunities where they can actually save tax.
So I think you guys have been very informative and helpful. I still need a refresher course after this class on the following, but I'd like to thank Christian. I hope you have a nice day in Southern California. Jay, enjoy the city of brotherly love, and I'll see you next week.
Okay, thank you, Mike.
Thank you, Mike.